There's a new auto loan interest deduction included in the Big Beautiful Bill. Starting with 2025 tax returns, some buyers of new U.S. assembly vehicles may be able to deduct the interest paid on their auto loans up to $10,000 per year. But this tax break comes with several important restrictions. Here's what qualifies. Number 1, the vehicle must be new and have final assembly in the United States. The loan must come from an unrelated party, so it can't come from a friend, family member, or informal lender. And it's important to note that used vehicles and leased vehicles do not qualify. There are also specific income thresholds that your income must fall below in order to qualify. The deduction begins to phase out at $100,000 for single filers and $200,000 for married couples, and it fully phases out at $149,000 for individuals and $249,000 for joint filers. This is an above-the-line deduction, which means you don't need to itemize to claim it, and you're still able to take the standard deduction. Here's a basic example. Let's say you take out a $50,000 loan at an 8% interest rate over 60 months. In the first year, you pay $3,700 in interest. If your marginal tax rate is 22%, that could mean about an $813 federal tax savings, but not all buyers will reach that level of deduction. According to analysts, you'd need to borrow more than $110,000 at a high interest rate to hit the full $10,000 deduction cap in a single year, something fewer than 1% of borrowers are likely to do. Additionally, the deduction is temporary, meaning that it falls into our temporary changes category. It applies only for tax years 2025 through 2028. So if you have a 6-year or 7-year loan, you'll only get a deduction for the first 4 years of that term. Eligible vehicles include most cars, trucks, SUVs, vans, and motorcycles under 14,000 pounds that are manufactured for use on U.S. roads. You can confirm whether your car qualifies by checking the window sticker or using the VIN on the NHTSA website. Some commonly mentioned models with U.S. assembly include the Toyota Camry, Ford F-150, Subaru Outback, Jeep Wrangler, and the Honda Accord. But remember, these aren't the only cars that qualify. If you're curious, you can check on the NHTSA website. However, certain popular vehicles like the Toyota Tacoma and Chevy Equinox are built outside the U.S. or across multiple countries, which is why double-checking is always important. This tax break is likely more relevant to the middle-income buyer who finances vehicles with higher interest rates and plan to hold onto them for several years. High-income households who pay cash or lease vehicles will likely see no benefit. As always, the exact amount of savings will depend on your income, loan size, and interest rate. The IRS is expected to provide additional guidance and possibly a list of qualified vehicles based on the final assembly location. Because the deduction is new and includes detailed income and vehicle eligibility rules, it's important to speak with a tax professional before making any financial decision based on it. For more breakdown of provisions in the Big Beautiful Bill, subscribe to the channel or follow along in the new series. See you next time.